Hey everyone, welcome to Retire with Style. I'm Wade, and I'm here with my trusted co host Alex, and we're ready to bring you an action packed episode on pitfall, the final one of the pitfalls that we're looking at. About we may want to voluntarily generate taxable income to have a more tax efficient retirement, but there are things outside of income tax brackets that can be impacted by generating taxable income. And the final one of those, Alex, is this idea of preferential income stacking.
Yes. Anything that stacks, I'm all about. Uh,
You
Wait,
play a
but
lot of Tetris, huh?
yeah, yes. Actually, did you see that movie? There was a movie on Tetris. Did you see that?
No.
Like I don't know. It's the Japanese company that ultimately got it. They like went into Russia to
Yeah,
buy
a
it,
Russian
but
guy
this was
invented
during
it.
the Cold War as the wall was coming down, or I don't even know if it was, because that's Germany. It was like Russia was crumbling, if you will, those last days, and it was kind of wild. Just the previews itself. I haven't seen it, so check it out.
Oh.
But that's not the question I have for you. The question I have for you is, how do you define action packed? We'll make this an
Excite.
action packed episode.
Yeah, we're gonna. Well, it's something that you may not have thought about, but actually can have a really big impact on your taxes. And so,
But how
be
is it packed
excited.
with action?
Well, it generates a lot of action and excitement in your mind as you realize you may be paying more taxes than necessary. I suppose.
Here we go. All right, that is good enough. I just
You're
wanted
really
to know
trying to
what
push
your
me into a
definition
corner here,
was.
huh? I'm
I just
trying
wanted
to
to know what your
trying to be a
preferential
salesman on the
definition of
episode.
action packed was. That's it. All right. Well, as we say here, nothing to it but to do it, right?
That's right, Alex. Okay,
Not,
and we have introduced the idea in past episodes, but to quickly refresh everyone's memory, there's two different kinds of taxable income in the United States.
the
You've
good and
got
the
your
bad.
ordinary income.
No, go
What?
on.
What?
Sorry. I said the good and the bad, and no, the bad and the worst. Sorry, my
The bad
bad.
and the worst.
Yeah. So
Well,
the
the
two
bad
types
and the
of
little
income.
better.
Exactly.
But you've got, yeah, ordinary income are most income sources. Your wages, interest on bonds, short-term capital gains, anything else that's coming in, it's taxed as ordinary income. In the US, we also have preferential income, which are specifically on a taxable brokerage account, realized long term capital gains when you're selling shares that you've held more than a year, and then qualified dividends, which get a special they're dividends, but they get a special tax treatment if you've held those assets for more than a year and so forth. Those have a separate set of tax rates. There's 7 different tax brackets for ordinary income, going up from 10% up to 37%. There's just 2 different tax brackets for, well, then there's an extra thing we'll talk about, the net investment income tax. But the basic preferential income tax brackets are either 15% or 20%.
So,
And they come in at different levels. Then,
so
Mhm.
preferential income has nothing to do about the income that you generate from things you like doing.
Well, you could get a correlation because this is where the capitalist comes into play. Once you have a big pot of assets, you can enjoy generating income from them.
So
And you
it's
may
all
prefer
preferential.
because you don't
It's
have to
all
work anymore.
preferential. At that point, it's all preferential. Okay, I get it.
Yeah, you're not working to earn this income. It's being spit off of assets that you've accumulated. So it's preferential in that regard.
Okay.
Okay, and it's the incentive to invest your assets. The we talked about the I don't know why they don't align these up, but at just about the same spot where the 12% bracket becomes a 22% bracket on ordinary income, the 0% bracket becomes a 15% bracket on preferential income. There's for singles, $125 difference between the two thresholds. I don't know why. And for married filing jointly, there's a $250 difference.
They were
But
probably just
they're
determined independently. They weren't determined, they didn't do these together. And so different steering committees or whatnot.
could be. But the other point to this too is your preferential income is stacked on top of your ordinary income to determine how it gets taxed. So maybe the easiest way to really treat this is to give an example. Suppose you're a single filer and you have $49,025 of income, your taxable income on your 1040. But it's when you break that down, that includes $45,025 of ordinary income and $4,000 of preferential income, long-term capital gains or qualified dividends. Okay, so if you had just $49,025 of ordinary income, and that would be in the 22% bracket. But that again, it's not all ordinary income. The 45,025, you're still in the 12% bracket on ordinary income, and then you stack the 4,000 on top of that. And when you look at where that 0 to 15% threshold comes into play, it's at $47,025. So half, the 2,000 of your long-term gains are still in the 0% bracket, and the other 2,000 are in the 15% bracket. Okay, so you've got 45,025 still in the 12% bracket, ordinary income. On top of that, you're adding your preferential income. 2,000 of that's in 0%, 2,000 of that is in 15%. Now the issue is, let's suppose I earn another dollar of income. I go back to work and I earn another dollar. How much tax will I pay on that dollar? So that dollar, ordinary income, it's going to get taxed at 12%. I'm still in that 12% bracket for ordinary income. But the other thing that dollar does is now there's only room for $1,999 of my gains to be in the 0% bracket. $2,001 of my gains are in the 15% bracket. So that
Remember,
dollar,
you had, just to say, there was $4,000 of altogether long-term gains.
yeah, $4,000 of long-term gains, and they cross the threshold between 0 and 15%. So that dollar, I'm paying 12% on that dollar, but I'm also uniquely now having to pay another 15% on a dollar of my gains. So my effective marginal tax rate on that dollar of income is 27%. 12% ordinary income tax, 15% preferential income, the tax, after stacking that preferential income on ordinary income. So I thought I'm in the 12% bracket with my ordinary income, and I was, but I'm paying 27% on that dollar.
Yeah, so anything above that, now you start getting clipped at a very heavy rate.
Yeah, and that will continue until all $4,000 of long-term capital gains are getting taxed at 15%. Then, when that happens, for the next $125, I'm still in the 12% bracket on ordinary income. Then I enter into the 22% bracket on ordinary income. But there's no more preferential income stacking problem until later when I get to the 20% bracket, I'm going to have the same problem where I'm pushing income from 15% to 20%. But also before that, we run into the net investment income tax as well, which is an additional 3.8% surcharge that comes into play at $200,000 for singles and $250,000 for couples. So when that happens, it's just my 15% is getting pushed up to 18.8%.
And this Medicare one, that came out during I want to say the Obama administration, right? So it's not something that's been around forever and ever.
Right. It's to help with the Affordable Care Act. Or no, it's actually Medicare. But you're right. It came in through the Obama administration. I forget exactly what it was earmarked to cover. But yes, it's an additional tax to help with covering health insurance for Americans. Now that one, we can make a few more comments about it because when we talk about nonlinearities in the tax code, this is another nonlinearity because it applies on the lesser of two numbers. It's not that you automatically have your long-term gains getting taxed at an extra 3.8%. It's that once you exceed those thresholds, they look at what's a smaller number, your modified adjusted gross income in excess of those thresholds, or your net investment income. And then whichever is smaller, that chunk gets taxed at an additional 3.8%. Your net investment income includes capital gains, interest, dividends on assets and taxable accounts, royalties, rents, and amongst other things, the taxable portion of non-qualified annuity distributions.
So then this scenario that we're pointing out is a little different. When we're talking about Social Security, the torpedo, we were always saying, watch out how much income you're making, like working income. Medicare, the last episode on Medicare was the same thing. You got to be careful how much income you're making. Here, it's you got to be careful what your gains are. You know, how much of your gains you're kind of recognizing in any given year. Is that a correct assessment?
Well, that's part of it. But also, if I'm thinking about doing a Roth conversion.
Oh, that's right. We're building up towards a Roth, so there's that in the background. Sorry, go on.
Yeah, if I'm thinking about doing a Roth conversion, this actually can be the trigger that stops the Roth conversion. Because if I'm like thinking, well, I want to pay taxes whenever I can do so at say less than a 20% effective marginal rate, and I'm in kind of the scenario I was describing before, where I'm still in the 12% bracket, but I do have these long-term gains that are still in the 0% bracket. As I'm doing those Roth conversions and paying tax at 12%, I'm going to eventually start pushing my gains into the 15% bracket too. And so my 12% effective marginal tax rate becomes 27%. And if I'm only wanting to pay taxes when I can do so at, say, less than 20%, if I was only looking at ordinary income being taxed at 12%, I'd keep going. But if I look at this holistic, your word from the last one, if I look at the holistic picture here.
Yes, the holistic picture.
Yeah, I'd be paying taxes at 27%. And then I'd want to put the brakes on and stop doing those Roth conversions. And I think this aspect of preferential income stacking, it doesn't get talked about very much. It does get mentioned from time to time, but I don't think people who are doing tax planning, it may not be natural for them to incorporating this into their planning.
Why not? Because this is like standard for us when you're doing a financial plan with us. Why wouldn't this be?
I think it's confusing. You got to go a couple levels deep here with, it's not just looking at your federal income tax brackets and your ordinary income. It's recognizing at the same time, I also have to keep track of my preferential income and how it's moving through its own different set of tax brackets.
I got you.
It's like 2 levels deep.
Yeah, this is where I think the consumer's a little up the creek simply because it's just tough for them to get I don't know, maybe you can just chat GPT this, but I don't think so. At least right now. Not in this era. as of right now. Maybe when they get the nuclear powered data centers they can crank out the bandwidth or something like that. But this is where financial planning tools, begin to do that trick a little more efficiently. That's why I was like, why not? Why wouldn't folks consider this? But when I'm asking why not, I mean more professionals, financial professionals, as opposed to individuals. Individuals, it's a lot of balls to kind of have in the air and figure out.
Yeah, you need good tax planning software to also keep track of this. But it also speaks to your point. Just generating more long-term capital gains actually wouldn't cause this problem. Since that's getting stacked on top of ordinary income, if I'm generating long-term gains, eventually they hit the 15% bracket, but I'm still, each dollar of long-term gains I generate, I'm just paying 15% on it. It's not interacting with my ordinary income because it's on top of the ordinary income already. So there's no double whammy from that. Like once, if I deem it as worthwhile, like I'm not worried about the step up in basis and so forth, I could realize long-term capital gains at 15%, maybe until I get up into the net investment income tax threshold, as a way to, in the future, avoid having to ever pay more than 15% on my long-term capital gains or other preferential income sources. But you don't necessarily want to just voluntarily realize income at a 15% rate because you do have that step up in basis potentially. But yeah, it's all part of the planning process. How should I strategically generate income and pay taxes on it? Because I can do so at a lower rate than I might have to in the future. Now that being said as well, if your income is low enough that you have excess capacity in the 0% range for your preferential income, yeah, go ahead and gains harvest. Sell your shares and immediately repurchase them to increase the cost basis and to trigger gains when you're able to do so in the 0% bracket. And after, again, going back to with our previous episodes, if this is pre having claimed Social Security, and if you're not getting Affordable Care Act subsidies for health insurance, and you probably do a lot of this pre-Medicare bumps, but monitoring the Medicare situation as well. If after considering all the nonlinearities and other aspects of the tax code, you can generate long-term capital gains at 0%, you might want to do that.
Okay.
You might want to stop at the 15% threshold.
So then with these three items that we mentioned in the last three episodes, the tax torpedo, the Medicare surcharges, that kind of stuff, the bumps, and this piece here on how you harvest your gains, how would you rank them in terms of your thought process of ultimately a Roth conversion strategy, in terms of, obviously everything is intertwined in a holistic plan, emphasis on the word whole, HOLE, but how would you rank this in order of like things that you have to align first, or they're kind of equally weighted?
Well, if you have an opportunity to get some control over your Social Security, that's perhaps the biggest one of these. And so the conversation there is, we talk a lot about delaying Social Security to 70. If you do that, you might be able to set up the situation where you do Roth conversions before you start Social Security. And then you kind of get some of those assets out of your IRA. You're not going to have as big of RMDs. You might be able, even with a couple $1 million of assets, you might be able to get into the situation where you can pay tax on less than 85% of your Social Security. So it's, with Social Security, you may not have a lot of flexibility because you may not be generating income voluntarily at that point. But setting up in advance, that's really to help manage the Social Security tax torpedo, is to prepare for this in advance of starting Social Security.
And taking care of that begins to set you up nicely for the next two things to start considering.
Mm-hmm. Yeah, and then as you start to get to higher income levels and you're doing tax planning, IRMA brackets may become the thresholds to keep. I don't want to voluntarily generate higher IRMA surcharges, but if as you get to wealthier levels, maybe you do want to work your way through the first IRMA bracket, because it's the second IRMA bracket that you decide to put the brakes on at. Those IRMA brackets, it's annoying, but it's either for one person about $1,000 extra, for two people $2,000 extra. It's not the end of the world, and you might deem it as worth paying that as part of your tax planning if you are allowing yourself to target higher effective marginal tax rates. There might be the capacity to take that in as part of the process and still stay under the effective marginal tax rate that
you know how many more lattes a year you can buy with that?
Yeah, quite a few.
Quite
But
a
you might
few.
volunteer. You might
We're
be able
back.
to eat as
Mortimer,
a
we're
part of tax
back.
planning. As a part of tax planning, you might be able to eat one of those IRMA surcharges and still keep yourself under. Again, for that $1, you're going to be way over any threshold because it's like a 99,400% marginal rate. But then as you go beyond that and continue to add income, you might be able to get that overall rate low enough that it was worth eating a surcharge. And then if instead you've already taken care of, I'm delaying Social Security, so I don't have it yet, I'm still below the levels where I have to worry about IRMA surcharges, the issue that may become relevant is the capital gains stacking, the preferential income stacking. So then I may do Roth conversions up until the point where I would also be pushing my long-term capital gains or qualified dividends from the 0 to 15% bracket. And then that might be the point where I stop with the Roth conversions. Those are all well, there's no clear stopping point with Social Security, because pretty much by the time you're out of the standard deduction, you're already dealing with the Social Security tax torpedo. But stopping at either where the preferential income stacking becomes a problem or where a Medicare surcharge becomes a problem, those are pretty realistic targets that might be more effective to consider than just, say, filling up my 12% bracket or filling up my 24% bracket.
I
Or
got you.
22, I should say, or 22%, which would come first.
Sorry, wait, I got to sneeze in between here, so it's holding back on me. I'm sort of letting you fly solo here for a little bit. While you're speaking, like when you're detailing these, what keeps going through my head is how important. We talk about the fragile decade from an investment standpoint, and that's effectively the 5 years leading up to your official kind of retirement and the 5 years after. If you're taking a sustainable withdrawal rate, that ends up being it disproportionately is more influential, if you
Mhm.
will, to your success than like any other point of time as you start doing these. And so we focus on that. But there's a fragile decade, which is kind of probably very similar, of financial planning for retirement income planning. And it's really aligning all of these things up. People are that transition from working paycheck to retirement income paycheck, right? It's you don't just flip the switch. Okay, I'm retired now. Boom, let's do this. There's a it just becomes second nature to me. But now listening to you and just forcing myself back, I'm not so sure if folks realize these items that need to be checked off as you enter retirement. From the standpoint of just having a smooth transition as opposed to bracing for impact, right? Because we worry so much about all these like retirement income strategies, but it's what you keep. And in many ways, having to do these things is not an optional thing. You're going to make a decision on this, whether you make that decision or not yourself. Somebody's going to make a decision for you on how much these payments are made, and so getting this right in this time period is essential. Really, I don't think there's hyperbole in that statement. It's just one of those things you have to do when you're listening to it. It's not just leaving it up to anyone's devices or however fortune lands. I mean, there's things you can actively do to make sure that you keep as much as humanly possible with regards to your own personal retirement income paycheck.
Yeah, it's really about an efficiency argument. Like, I guess, I mean, the worst case scenario with all this is if you're paying more taxes than you needed to, and therefore you're have
Yeah, but
less
these
after
but these are
tax
the same
assets.
people that then complain about like whatever something peanuts, if you will. My Netflix subscription, I need to cancel it, right? Because they want to save $20 a month or whatever. $20 more a month. Not that Netflix is more than that, but you know what I'm getting at. Like you worry about the pennies when there's somewhat dollars here to be had, and
Mhm.
and with proper planning, you'll take care of that.
Yeah, that's part of that behavioral finance where people will put more effort into a $20 decision when they're overlooking just a little bit of effort, how they could be saving thousands of dollars somewhere else.
Yeah,
And this is the
exactly.
category of where you could potentially be saving thousands of dollars.
To me, this is like the equivalent of somebody like when they're investing and they have a mutual fund that they bought and it's charging them, I don't know, 1.5 a year, 1.5% a year. And they don't think twice about it because they don't see it. And they just assume, well, this person is good. They're going to outperform the markets and whatever. They call it a day. Right. But they don't. And then that same person, you know, skimps on everything else. I'm not going to the movies. I'm not buying popcorn or whatever. Right.
Uh-huh. Uh-huh.
This is kind of that equivalent for the retirement stage, where it's like pay attention to these things because these things will matter over time, not the latte a day thing in retirement. It
Mm-hmm.
just boggles my mind every time. And listening to you kind of like line these things up, I'm like, why aren't more people paying attention to this?
Yeah. Yeah. Well, now that you're listening to Retire with Style, you'll have the style to pay attention
Now
to.
you know, and that's why it's the eighth most important life altering event.
And knowing's half the battle.
There you go. All right.
Okay.
And we have some more to discuss, right? But we can do that in our next episode. Some
Yeah.
more
Yeah. We
groundwork for
just,
you to think about.
we want to talk about a few other planning ideas just as part of that conversation, and then getting into case studies. And at some point, we're going to bring in some advisors as well. And
Yeah, we're
about,
kind of trying to lay down the language and the definitional stuff and the higher level stuff. That way, when we bring in advisors that talk about case studies, you know, there's more familiarity with these terms.
mm-hmm.
All right, everyone. Thank you for listening in, and we'll catch you next time on
Retire with Style.
Dude, we're like Captain and Tennille, you and I. Wait.
We finish each other's
Sentences. Wow, look at that. All right. Catch you later, everyone. Bye.